Right now, as you're watching this, the most ambitious economic experiment in human history is blowing up in slow motion. And if you're not one of the people who designed it, you're the one who's going to pay for it. For 40 years, politicians, central bankers, and economists told you they had finally cracked the code. No more painful recessions. No more brutal resets, no more hard limits. Just credit, stimulus, low interest rates, and temporary money printing to keep everything drifting higher forever. They called it modern, they called it sophisticated, they called it sustainable. It wasn't. It was an experiment, one that's now failing in exactly the way history says it always does: asset bubbles for the top, inflation and instability for everyone else, collapsing trust in money itself, and a desperate scramble by governments to decide who will be sacrificed to keep the system alive a little longer. The story you were sold was simple. After World War II, we learned from the Great Depression. We built smarter institutions. We created the IMF, the World Bank, the Federal Reserve as global firemen, the ECB, the Bank of Japan. The lesson you were told was that whenever the economy gets into trouble, smart people at central banks can manage it by tinkering with interest rates and money supply. Then, after 1971, when the last link between the dollar and gold was cut, another idea quietly took over: money doesn't have to be anchored to anything real as long as we have good models and responsible technocrats. Debt doesn't really matter if interest rates are low enough. Crises don't have to cleanse the system if we can just print our way through them. That was the global economic experiment: unlimited fiat managed by committees, fine-tuned with equations, sold as salvation. It had 4 stages. Stage 1, liberation. The dollar left gold. Other currencies floated. Capital controls came down. Banks were deregulated. Derivatives exploded. Globalization went into overdrive. For a while, it felt like a miracle. Countries could borrow more. Consumers could spend more. Housing boomed. Stocks soared. Every downturn was met with a rate cut. Every panic with a bailout. The pain of the 1970s inflation faded, and in its place came something economists called the Great Moderation, decades of relatively low inflation and steady growth. It looked like proof the experiment was working. Stage 2, financialization. As interest rates trended down and credit expanded, the center of gravity in the economy shifted. From factories to finance, from production to speculation, from saving to asset returns, governments outsourced responsibility to central banks. Companies realized it was more profitable to borrow cheap, buy back their own stock, and cut costs than to invest in real capacity. Families realized their house and their 401k were their real safety net, not their wage. Every bubble.com housing, sovereign debt, everything after 2008 was larger than the last, and every time it burst, the response was the same: more liquidity, lower rates, bigger interventions. What used to be an emergency tool became the default setting: stage 3, delusion. Around 2008, the experiment hit its turning point. The global financial crisis was the moment the system should have taken its medicine. 2 big-to-fail banks should have been broken, bad debts written off, and the economy forced through a brutal, cleansing reset. Instead, central banks doubled down. The Federal Reserve took rates to zero and launched quantitative easing, creating money to buy bonds and mortgages. The ECB and Bank of Japan followed. Years went by with negative or near zero interest rates in the developed world, something literally no previous generation of humans had experienced at scale. A new creed emerged. As long as inflation stayed low, central banks could create as much money as they wanted without consequence. Governments got hooked. After 2020, during the pandemic, they hit the gas: trillions in new debt, trillions in central bank asset purchases, stimulus checks, furlough schemes, whatever it takes on a scale nothing in history matched. Stage 4, reality. That's where we are now. Inflation. Bond markets breaking. Banks under stress. A cost of living crisis that makes official statistics look like fairy tales. Social trust eroding. Political systems fragmenting. The belief that the people in charge know what they're doing. Collapsing. That's what it looks like when the global economic experiment fails. You can see the failure in the numbers the system itself produces. Global debt, public and private, now sits above 300 trillion. That's over 3 times global GDP. If the world devoted every dollar of output for 3 straight years to paying down debt, with no food, no energy, no salaries, it still wouldn't be enough. For years, we were told this was fine because interest rates were near zero. Debt didn't matter when you could roll it forever at negligible cost. That was the core assumption of the experiment. Then inflation hit 2021, 2023. Central banks were forced to hike rates at the fastest pace in modern history. Suddenly, all that cheap debt isn't cheap anymore. Governments are paying more to service their obligations. Households are paying more on mortgages and credit cards. Corporations are paying more to roll their loans. And the bond portfolios that were supposed to be safe, Inside banks' pensions, insurance companies have taken massive mark-to-market losses. That is the global experiment failing in real time. You also see it in the silent collapse of the middle class. For a decade after 2008, central banks congratulated themselves for saving the system. But what system did they save? Not the one where a single income could buy a house, raise a family, and build a nest egg. That system died. The system they saved was the one where the holders of financial assets, stocks, real estate, bonds saw their wealth explode, while wages stagnated and costs for everything that matters, housing, healthcare, education, childcare, rose far faster than official inflation acknowledged. When you create trillions in new money and push interest rates to zero, that money doesn't quietly spread evenly through society. It flows first to those closest to the spigot. Big banks, big corporations, big investors, they buy assets. Asset prices go up. If you already own assets, you feel rich. If you don't, you fall behind. That was the real output of the experiment-engineered inequality. When inflation finally broke out after years of, "It's too low, we need more," the official story was that it came from supply shocks, a virus, a war, bad luck. But the deeper truth is that you cannot expand the money supply and the credit base at the pace we did, for as long as we did, without eventually deforming the price structure of the entire economy. The experiment assumed that central banks could always pull the levers just right. They didn't. They're human. They overcorrected. They waited too long. They called inflation transitory when it was clearly structural. By the time they admitted the mistake, the only tools they had left were the same tools that created the problem: rate hikes and more emergency programs. Now, the question that matters is simple: who pays? History is merciless on this point. When an economic experiment that benefits the top fails, the costs are never borne proportionally. The designers keep their seats. The institutions survive. The model is rebranded. The sacrifice falls on savers who find their cash and bonds eroded by inflation or explicit restructuring, wage earners who watch their real incomes squeezed between rising prices and corporate cost cutting, taxpayers who are told there is no choice but to fund bailouts, subsidies, and interest bills, the young who inherit a system where every path to stability is more expensive than it was for their parents. You're living through that reallocation now. If you hold a traditional 60-40 portfolio of stocks and bonds, you've already seen both sides of the experiment cut into you. First by central banks inflating asset prices and making everything feel expensive. Then by the same central banks hiking rates and crushing the valuation of the bonds that were supposed to protect you. If you hold your safety in bank deposits, you've watched your purchasing power fall by double digits in a few years, while the nominal number in your account stays the same. If you tried to sit out the madness in cash, you've been silently taxed to plug holes you didn't dig. At the same time, the global economic architecture that made the experiment possible is coming apart. For decades, the dollar-centric system allowed the U.S. and its close allies to run this experiment with the rest of the world's blessing. Foreign central banks bought U.S. debt. Global trade was invoiced in dollars. Emergency swap lines and IMF programs stabilized crisis. In return, the world accepted that one country, backed by its central bank, would be the issuer of the ultimate safe asset. That deal is breaking. The weaponization of finance sanctions, asset freezes, SQFT expulsions sent a clear message to every country outside the Western club: your reserves can be turned off. Combine that with the visible failure of the experiment at home: inflation, political chaos, repeated crises, and you get the trend we see now: gradual, quiet diversification away from the dollar system. That doesn't mean the dollar disappears tomorrow. It means the marginal bid weakens. Countries hold a bit more gold, a bit more local currency debt, a bit more exposure to China, to B-rice, to alternatives. Each percentage point they shave off their dollar dependency is a vote of no confidence in the experiment. And again, who pays for that loss of confidence? You do, in the form of higher interest rates than you were told were normal, a weaker currency over time as global demand erodes, more aggressive taxation and financial repression to keep the domestic system from spinning out. Financial repression is a polite term for locking you in and turning the dials against you. Capping deposit rates below inflation, nudging pensions into government bonds, tightening capital controls, floating ideas like windfall taxes, and solidarity levies on assets that still hold value. When the experiment fails, the people who built it don't say, "We were wrong," will absorb the loss. They build a narrative about shared sacrifice and ask you to do your part. That's exactly what you're hearing now. Everyone has to accept a bit of inflation. We all need to live with higher taxes to support the system. Retirements may need to be adjusted for sustainability. Translation. Screen, the experiment failed, and you're the variable they're going to adjust. There's another layer, social trust. Money is not just paper or numbers on a screen. It's a story we tell ourselves about value and obligation. For the last 50 years, the story was, central banks are independent, experts are in control, the currency is stable, and the system is fair enough. That story justified incredible power concentrated in a small number of institutions. It allowed the experiment to run this long. But as more people feel the squeeze, see the contradictions, and live through repeated once lifetime crisis, that story loses its grip. When trust in money and in institutions breaks, people don't calmly wait for a better model. They react. They speculate. They polarize. They look for scapegoats. They grab for anything that feels solid: land, commodities, hard assets, alternative monetary systems, political extremes. You're seeing the early stages of that everywhere. From cryptomanias and collapses, to populist waves, to runs on shadow banking products in China and small banks in the US. Those aren't random anomalies. They are the nervous system of the global economy reacting to the failure of the experiment. And here's the uncomfortable part: there is no clean exit. You cannot simply turn the clock back to a normal, pre-experiment economy. The debt is there, the demographics are there, the political promises are there, the asset prices built on 0% rates are there. Any path forward involves some combination of FARS inflations, letting prices run hotter than advertised to reduce the real burden of debt, free austerity and taxation, cutting promises and squeezing revenue out of those who still produce and own, defaults and restructurings, explicit or hidden write-downs of debts that cannot be paid, a currency regime change, eventually moving to a new system, with new rules and new winners. In every scenario, average people who believe the system's promises take the hit. Their savings expectations and plans are the shock absorbers. You can't vote the experiment away. You can't tweet it away. You can't wish it away. You can only decide how much of your life you want indexed to it. If you continue to store all your wealth in the units and instruments that define the experiment, long-dated government bonds, cash piles in a banking system that only survives if you consent to be diluted, inflated asset classes whose prices assume free money and endless growth, you have, by default, volunteered to be the backstop. If instead you start thinking like the actors who understand that the experiment has failed not just in Washington or Beijing, but in every capital that believes central banks could replace discipline with models, then you ask a different question. What still holds value when the story breaks? History's answer is brutally consistent: real assets with intrinsic utility. Businesses that produce things people cannot do without. Skills and networks that survive regime shifts. And forms of money or stores of value that governments can't conjure with a keystroke. That doesn't mean there's a magic hedge or an easy trade that makes you rich when everyone else suffers. It means you stop confusing nominal numbers on statements with real security. You stop believing that back to normal is an option when the experiment was the abnormal period. The global economic experiment just failed. Not because one central banker raised rates too late or one politician passed the wrong bill, but because the core premise that you can print and manipulate your way around the hard limits of debt, discipline, and reality was always a fantasy. We stretched that fantasy across the entire world. We built retirement systems, housing markets, corporate structures, and political promises on it. Now the bill is coming due. The only real question is whether you walk into the next phase blind, still believing the people who designed the experiment will somehow redesign it in your favor, or whether you finally start